A stock shock is coming. I'm your host, Steve Van Metre, and thanks for joining me today. Bank of America is warning investors of a nightmare scenario that could send stocks tumbling. Let's head over to the Wall Street Journal where we picked today's story up as the other doomsday scenario looming over the market. Bank of America equity strategist says quantitative tightening alone could lead to another 7% stock price drop. We'll just say probably a lot more as the boost from QE is reversed. And the global head of fixed income research at HSBC thinks the interaction of QT and the plumbing of the financial system is too complex for anyone to predict properly. The truth of it is, he says, no one really knows. Well, I don't know about that, but we can take a look at this chart where we have the Fed's balance sheet or monetary base in blue against the Wilshire 5000 or the total U.S. stock market in red, both on a year-over-year rate of change. And we can see when the Fed contracts its balance sheet, highlighted in yellow, is when we last did quantitative tightening. And lo and behold, the stock market went down. And well, hey, what a surprise. You can see it happening again. The Fed's contracting their balance sheets, their quantitative tightening, and stocks keep heading lower. The last time QT was tried under Fed Chairwoman Janet Yellen, now Treasury Secretary, it went perfectly until it suddenly didn't. And Janet Yellen said the predictable pace of the balance sheet reduction starting in 2017 should look like watching paint dry. And it did right up until things broke. Then in 2019, the overnight lending market, crucial to the financial system and reliant on plentiful reserves, seized up, forcing an emergency rescue to prevent a full-on credit crunch. And QT is a bit different this time, or so they say. The main reason is because we get into it, a quick reminder on central bank reserves for those who haven't delved into the monetary system in a while. The Fed creates reserves as a special form of dollars that can only be held by banks and some similar firms that use it to settle debts with each other. The rest of us mostly use bank-created electronic money plus physical dollars. And since QE began, reserves have ballooned as the Fed created reserves to buy bonds from banks. And believe it or not, we finally have a news point that is actually correct, that all the Fed did was say, hey, banks, we're going to give you this token, this called reserve asset, and we're going to swap that with your bonds. That's all QE did. Now they're reversing that process as those bonds mature. They're giving the cash back to the banks and saying, hey, it's up to you to do what you want. If you want to create reserves, you can do that, but we're not going to make you do that anymore. And here we can see the relationship between the Fed's balance sheet and the reserves of depository institutions, with the Fed's balance sheet in blue and bank reserves in red. And you can see very similar as the Fed forces the banks to create reserves through quantitative easing, reserve balances rise. And as, of course, the Fed unwinds its balance sheet, showing here in red, what we can tell is reserves head lower. This makes sense. And why does that happen? Because what do banks do with money? What do they want to do when they have your deposit? How do banks make money? You got it. They lend it. Not buying bank reserves or treasuries is what we see what the Fed forces them to do. So all this is showing us is that banks are getting back into the business of banking. And unlike in 2017, large quantities of reserves have been returned to the central bank via money market funds. This, not true at all. A misunderstanding. These funds, which savers use as a liquid alternative to savings accounts, are allowed to deposit money at the Fed overnight using reverse repurchase agreements or RRPs, this part being correct. And they've already sucked up $2 trillion of reserves out of the system, up from zero at the start of the year. And here you can see in this chart of the overnight reverse repurchase agreements shooting up to over $2 trillion. And this is money market funds, my friends. This is money market funds parking your money at the Fed overnight to get the interest they need to pay you. That's all you're seeing here. And so that's what's going on. And what we look at is this relationship between the overnight repurchase agreements and bank reserves. And we can see what happens is these are surging higher, these overnight repurchase agreements, as reserves fall. So what are you actually seeing here? And maybe this is something you've experienced at your bank. And this is real simple. A bank can come to you and say, look, that savings account you had, it's now a money market savings account. Or that checking account, it's now a money market checking account. And all they're doing is saying, look, we don't want these deposits on our books anymore. They're no good to us. They're not making us any money. So we're going to shove them off over to the Fed. So what you're seeing with this reverse repo is there's actually a collateral shortage. That's what this means. There's not enough treasury bills out in the market. So what happens here is these money market funds go to the Fed, give them their cash. In exchange, the Fed gives them an overnight asset and pays them interest. That's right. The Fed is paying interest on over $2 trillion of money markets right now. That's what you're seeing. And for now, the loss of reserves isn't a problem as banks had too many deposits, shocking, and reserves anyways. They still have $3.3 trillion of reserves, more than they had until the last year, but there are indeed risks. Ruffer's concern is the loss of reserves will impede the bank's willingness to take risk, and that isn't true at all. That doesn't matter too much when the markets are calm, but to put it mildly, they aren't. And he expects widespread withdrawals from fund managers after the terrible year they've had, forcing sales of stocks and bonds. And if banks are constrained and unwilling to deploy money, they won't cushion price declines, and markets could drop suddenly. And if there's one thing that if Ruffer's right, this shouldn't drop suddenly, if all this happens, that's your portfolio. I'll put a link up here to Portfolio Shield and description below, because there's a part of this he's got wrong. The banks actually don't want these reserves. See, this case that I've made is QE is cancer to the financial system. It forces banks to create reserves out of deposits rather than lend. And what businesses banks are in? They're in the business of lending. But if they can't lend because the Fed doesn't allow them, then what happens? What should we see when the Fed starts doing QT? Well, we should see lending go up. And sure enough, lo and behold, we can find out there are periods where we see these reserves dropping. Now, it may not be specifically because of quantitative tightening. Here in the second yellow part here, we can see quantitative tightening as reserves contract. But here we can see reserve growth just slowing on a year-over-year rate of change. And we've got overlaid against this on blue, loans and leases and bank credit. And lo and behold, what do we see? As reserve growth slows or contracts, what do you see? Lending demand increases. And notice a peak here as this reserve growth started to fall. Bingo, boom, we see banks getting back into the lending business. And of course, the nightmare scenario to all this is what happens if indeed we have another collateral shortage, which we're facing now, or the Fed goes too far and breaks the markets. And if money market funds keep grabbing deposits and parking them with the Fed's reverse repo facility, that cap could be reached soon, perhaps this January, forcing the Fed into embarrassing early into QT. As an alternative, it could cut the rate it offers money market funds and try to shift that money back to bank deposits instead, which is not actually what would happen. Where this stops being wonky is an early into QT would mean higher rates would be needed for the Fed to tighten policy the same amount, something sure to hit stocks. So let's talk about what would actually happen here, since they've got this completely wrong. What you have is $2 trillion or a little bit more that doesn't have collateral to back it. See, money market funds under the Money Market Act have to buy collateral with your money to pay you interest. You know, it's not like they have some magic money fairy that pays interest on money markets. It's U.S. Treasury securities. And if you read the act, it doesn't actually say that they have to buy T-bills. But if you go through all the requirements, you come to the conclusion is there's only one thing that fits the bill, and that's T-bills. And so what happens right now is there's a shortage of collateral in the market. So if the Fed were to actually lower the rate on this overnight reverse repo, it would force all of this cash to go find T-bills. Now, what would that mean to rates? Yeah, they'd plummet. So in a sense, what you're seeing here is the Fed keeps raising this overnight repurchase rate as they raise the federal funds rate, and it's a form of quantitative tightening. So when the market breaks, when something in the economy breaks and the Fed needs to do some quantitative easing, well, they won't even have to. All they'll have to do is take that overnight reverse repo rate and go negative. And what we can see here is what happens is as all this money gets built up, we can see the overnight reverse repo here through 2015, 16, 17, 18, it got drained down. And then what happened? The yield curve showing here in red inverted, and the Fed did QE. Well, now they wouldn't have to do QE at all. They could keep doing quantitative tightening, and all they would have to do is unleash this $2.2 trillion of overnight reverse repo back into the market. It would slam the front end of the curve down, probably maybe even take it negative, and that would bring all all the other parts of the curve down with it. This is what the Fed's up to. This is double quantitative tightening in reverse repo plus their normal amount they're doing, which is set to double this month. That doesn't start till the 15th. That's the scenario the market should be worried about in dropping asset prices. But that's not all. We see another nightmare scenario forming in China as it cuts its forex reserve ratio in a bid to support the tumbling yuan. Financial institutions will need to hold 6% of their foreign currency deposits in reserve starting September 15th. The People's Bank of China said in a statement on Monday, lower than the current level of 8%. And the move is expected to increase the supply of foreign currencies, thereby making it more appealing for traders to buy the yuan. So money's leaving the country. And the PBOC sent a strong signal to defend the yuan exchange rate. This action shows that PBOC is not willing to tolerate a sharp yuan depreciation against the dollar, a case that I've made, and we've heard on the show that I've said the PBOC is likely to do what? Devalue the yuan. And why is that? Because money's leaving the country, and in a global reserve system, the last thing you want when you're an exporting nation is money to flow out. You want it to flow in and stay there, and this is a huge problem. As China's financial institutions held $953.6 billion of foreign currency deposits as of July, down from a record $1.1 trillion in February. A stockpile served as a buffer for the yuan amid headwinds. The Chinese currency is still around these levels seen in December in trade-weighted terms, but I'll tell you what, look for that. Look for, if that number continues to go down, watch China deval, because things in Europe are pretty bad too. Their nightmare scenario is they're headed to a depression as Euro stocks tumble as Russia pulls the plug on gas supplies. The gas halt is another blow to European economic outlook, which has left the euro to weaken in the near term due to governance-related risk, which will send the dollar higher. At the same time, yet another stimulant package from Germany in an attempt to keep growth afloat, which makes inflation forecasting the job for the ECB more tricky. Now, what I want you to understand here is there's a couple problems. They're going to try to stimulate an economy that has an energy crisis. Now, what do you need for your economy to grow? You need energy. So this is not going to work. On the other side, what did you just hear? The euro is going to weaken. And what is the dollar trade mostly against? Well, the euro. That means the dollar goes higher, the yuan goes down, China's going to be forced to deval. You see how this is all taking shape? It's happening right before your eyes. And this may lead to additional tightening in Europe due to prolonged inflationary pressures, as we see there are growing expectations for the ECB to raise rates by 75 basis points as soon as Thursday. The decision remains a challenging one as Christine Lagarde and her colleagues manage the twin problem of high inflation and impending recession. Boy, if you see them back off of that rate hike, watch rates come down as a sign the central bankers are capitulating. But look at this. Here's the problem. You can't solve a cutoff in gas supplies with higher interest rates and tighter monetary policy. It doesn't work. There's no relationship. It just makes the scenario worse. But the ECB, don't worry, they're cowards when it comes to tightening. We'll see if they back off this time too. But now you see what Bank of America is worried about. More tighter monetary policy, lower stock prices, Europe heading into a depression, and China forced to deval. Doesn't look too pretty, but we'll stay on top of it. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.